If you are watching gold above $4,500 and silver pushing towards $70, then you are watching more than a normal precious metals rally. Something important has changed beneath the surface. The US Treasury just made a move that sent bond yields lower and the dollar weaker. Gold responded with one of its strongest weekly gains in months. Silver followed with a powerful surge towards $70. The bigger question is not simply why gold is rising. The bigger question is what the Treasury move tells us about the pressure inside the US bond market. Because if this pressure continues, then gold and silver could be entering a very different phase. Gold has now pushed above $4,600. Silver has traded around the $70 area and briefly moved above that level during Friday trading. Gold finished the week near $4,624 in futures. Silver finished near $69.47. That gave gold a weekly gain of more than 5% and silver a weekly gain of almost 7%. That is a major move. But the most important part is what happened underneath the price. This rally was not created by one simple headline. It was created by a chain reaction. The Treasury changed its approach to long-term debt buybacks. Bond yields reacted. The dollar weakened. Investors reassessed interest rate expectations. Gold broke through important technical levels. Silver followed. And suddenly, precious metals became one of the strongest areas of the financial market. This is why you need to understand what the Treasury just did. The US Treasury announced that it would increase its buybacks of longer-dated Treasury securities. The goal is to provide additional liquidity and help improve conditions in the long-term bond market. The announcement came after pressure had been building in longer-term Treasury yields. At first glance, this might sound like a technical debt management story. It is not. It matters because long-term Treasury yields influence almost everything. They influence mortgage rates, they influence corporate borrowing costs, they influence government financing costs, they influence the valuation of stocks, they influence the dollar, and they influence gold. Gold does not pay interest, so when Treasury yields rise sharply, gold becomes less attractive relative to bonds. But when long-term yields fall, the opportunity cost of holding gold becomes smaller. That relationship was visible immediately after the Treasury announcement. Gold surged, the dollar weakened, long-term Treasury yields moved lower, and investors started pricing a different outlook for the financial system. Reuters reported that spot gold jumped more than 3% after the announcement and briefly reached $4,499 before continuing higher in the following sessions. The dollar index fell about 0.8% during the initial move, while 30-year Treasury yields also dropped. This is the part many investors miss. The Treasury did not announce that gold should go higher. The Treasury did not announce a new gold policy. The Treasury did not announce a new silver policy. But the market interpreted the move as a signal about the pressure facing the long end of the bond market. That interpretation matters. Markets trade expectations, they trade probabilities, they trade confidence. And when investors believe that authorities may need to support the bond market more aggressively, they begin thinking about what that could mean for inflation and the dollar over time. That is where gold becomes extremely interesting. Gold is often viewed as protection against monetary uncertainty. It is also viewed as protection against currency risk. And it is increasingly being treated as protection against fiscal risk. The United States now has an enormous debt burden. That means the cost of borrowing matters more than ever. Imagine a country with a small amount of debt. A modest increase in interest rates may not create a huge problem. Now imagine a country with debt measured in tens of trillions of dollars. The same change in borrowing costs can become much more important. This is why investors watch the 10-year Treasury, they watch the 30-year Treasury, they watch the yield curve, they watch auctions, and they watch Treasury demand. When long-term yields become uncomfortable, the entire market starts paying attention. That is exactly what happened. The Treasury buyback announcement helped push long-term yields lower. The dollar also weakened. And that created a powerful combination for precious metals. Gold becomes more attractive when the dollar weakens because gold is priced in dollars. For buyers using other currencies, a weaker dollar can make gold relatively cheaper. That can support international demand. But there is another layer. A weaker dollar can also signal changing expectations about U.S. monetary policy. If investors believe rates will eventually move lower, then the dollar can lose some support. And when the dollar loses support, gold can benefit. This does not mean every dollar decline automatically creates a gold rally. It does not. Markets are more complicated than that, but when the dollar falls at the same time that long-term yields fall, the combination can be extremely supportive for gold. That is exactly what we saw this week. Now look at silver. Silver is a completely different animal. Silver has monetary demand. Silver also has industrial demand. That means silver can benefit from precious metals investment flows while also receiving support from industrial applications. Silver is used in electronics. Silver is used in solar technology. Silver is used in electrical systems. Silver is used in advanced manufacturing. That creates a unique demand profile. When investors become bullish on gold, they often start looking for additional opportunities in silver. This can create a powerful rotation. Gold breaks out first. Silver follows. Then silver starts outperforming. That is why the $70 level matters so much. Silver reached a high around $70.14 during Friday trading, according to market reports. It later traded close to $69.50. So silver is already testing the psychological barrier. The question now is whether it can stay above it. That matters because round numbers often become psychological battlegrounds. $60 mattered, $65 mattered, now $70 matters. If silver can establish $70 as support rather than resistance, then traders may begin looking toward the next major technical zone. Some technical analysts are watching $72 as another important level. A sustained break above that area could open the door towards significantly higher targets. But we need to be careful. A breakout is not the same thing as a guarantee. Silver can move extremely fast. That means it can also reverse extremely fast. A market that rises 7% in 1 week can easily experience a sharp profit-taking event. That does not automatically mean the long-term trend has ended. It means volatility is part of the game. Gold is also showing strong technical momentum. The metal moved above its 200-day moving average. That level had been acting as an important barrier. Once gold moved above it, technical traders became more interested in the upside. Reuters reported that the move above the 200-day average around $4,513 was a significant technical development. Now, gold is trading above $4,600. That changes the chart. It changes investor psychology. It changes momentum, and it changes the conversation around the next major resistance levels. One obvious area is $4,700. Another is $4,800. And beyond that, the $5,000 level becomes a major psychological target. But again, there is no guarantee that gold reaches $5,000. Markets do not owe us a particular outcome. What matters is the structure. If gold continues holding above its breakout area, then the bullish structure remains intact. If gold falls back below the breakout area, then traders may start questioning whether the move was overextended. That is why the next few sessions are so important. Now we need to talk about the Federal Reserve. This is where the story becomes complicated. The Treasury and the Federal Reserve are not the same institution. The Treasury manages government debt. The Federal Reserve manages monetary policy. The Fed controls the federal funds rate. The Treasury manages issuance and buybacks. But markets connect them. Why? Because both influence financial conditions. The Fed can influence short-term interest rates. The Treasury can influence the supply and structure of government debt. Investors look at both when deciding where interest rates may go next. This week, the Federal Reserve minutes created a fascinating contrast. Several officials remained concerned about inflation. Some officials supported a rate increase at the July meeting. The committee ultimately kept the federal funds target range at 3.5% to 3.75%. Yet after the Treasury announcement, the market focused more heavily on falling long-term yields and a weaker dollar. That helped precious metals rally despite the relatively hawkish tone in the Fed minutes. This tells us something important. The market is no longer looking only at the Fed, it is looking at the entire financial system. That is a major shift. For years, investors could focus almost entirely on Fed policy. Now, fiscal policy is becoming increasingly important. Government debt is increasingly important. Treasury auctions are increasingly important. Long-term yields are increasingly important. And the dollar is increasingly important. This is why the current gold rally has a different character. It is not simply a bet on lower interest rates. It is also a bet on the possibility that long-term real rates may become less restrictive. It is a bet on fiscal uncertainty. It is a bet on currency diversification. And it is a bet on continued demand for hard assets. The World Gold Council has also highlighted the importance of the Treasury buyback story. Its analysis said the move should not be confused with formal yield curve control, but noted that the market reaction was significant. Yields fell, the dollar fell, gold rallied strongly. That distinction matters. We should not call this yield curve control, that would go too far. But investors can still ask whether the Treasury is becoming more active in managing the long end of the market. That question is enough to influence expectations. And expectations are what move markets. Now consider inflation. This is another major piece of the puzzle. If inflation is cooling, then the Fed has more room to lower rates. That can support gold. But if inflation remains sticky, then the Fed may need to remain restrictive. That can pressure gold. At the same time, inflation can also increase demand for gold as a hedge, so gold can sometimes rise even when inflation is bad for rate expectations. That sounds contradictory, but it makes sense when you understand the difference between short-term and long-term thinking. In the short term, higher inflation can push yields higher. That can pressure gold. In the longer term, persistent inflation can increase demand for gold as a store of value. That is why the market reaction can change from one day to another. Oil prices are also important. Higher oil prices can increase inflation pressure. Geopolitical tensions can push oil higher. That can complicate the Fed's policy path. And it can create another layer of uncertainty for investors. At the same time, geopolitical risk can increase safe haven demand for gold. So once again, the same event can produce opposing forces. This is why professional investors watch several markets at the same time. They do not look at one chart. They look at the relationships: gold versus the dollar, gold versus real yields, gold versus treasury yields, silver versus gold, oil versus inflation expectations. And all of those relationships tell a different part of the story. Now there is another factor that deserves attention: central banks. Central banks have been major buyers of gold in recent years. They are not usually buying gold because they expect a short-term breakout. They are buying it as a reserve asset. That makes their behavior different from short-term traders. Central banks can provide structural demand. They can also reinforce the idea that gold is becoming more important as a reserve diversification asset. The World Gold Council continues to emphasize gold's role as a strategic portfolio asset and a source of diversification. That does not mean central banks will buy at every price. They will not. High prices can slow physical demand, but the long-term trend matters, and this trend has created a stronger foundation under the gold market. Now look at the gold to silver ratio. When gold rises faster than silver, the ratio tends to increase. When silver begins outperforming, the ratio falls. The recent move in silver towards $70 is important because silver is starting to show stronger relative momentum. If silver continues to outperform gold, then the ratio could move lower. That would tell us investors are becoming more aggressive within the precious metals sector. Gold is usually the first destination. Silver is often the higher beta destination. That means silver can deliver larger percentage gains, but it can also deliver larger percentage losses. So if you are watching this market, do not assume that silver simply follows gold. Sometimes silver leads, sometimes silver lags. Sometimes silver moves sideways while gold rallies. The relationship changes with economic conditions. Industrial demand also matters. If global growth accelerates, silver can receive additional support. If manufacturing weakens, then industrial demand can become a headwind. This is why silver is more complicated than gold. Gold is primarily monetary. Silver is both monetary and industrial. That combination creates enormous potential. It also creates enormous volatility. Now let's return to the phrase in the title. The US Treasury just changed everything. Did it really change everything? Not literally. The Treasury did not change the entire monetary system overnight. It did not eliminate inflation. It did not eliminate the national debt. It did not force the Federal Reserve to cut rates, but it changed the market conversation. That may be even more important. Before the announcement, investors were worried about rising long-term yields. After the announcement, investors were asking what the Treasury might do next. That changes expectations, and expectations drive markets. The move also demonstrated something else. When the market becomes sensitive to long-term Treasury yields, gold can respond extremely quickly. That means future Treasury announcements could become important catalysts. A large auction, a change in issuance, a change in buyback operations, a surprise fiscal announcement. Any of these could create volatility. So if you only watch the Fed, you could miss the next major move. Watch the Treasury too, watch the bond market, watch the dollar, then watch gold. That sequence can give you a much clearer picture. Now let's talk about the bullish scenario. Imagine long-term Treasury yields continue to stabilize. Imagine the dollar continues weakening. Imagine inflation remains manageable. Imagine the Fed becomes less hawkish. Imagine central bank demand remains solid. Imagine gold continues holding above $4,500. That combination would create a very strong environment for gold. A move toward $4,700 would become more credible, then $4,800, and eventually the market could begin discussing $5,000 with much greater seriousness. Silver could also benefit. If silver breaks and holds above $70, then 72 becomes an important next test. If that level breaks with strong volume, then higher targets could come into focus. But there is also a bearish scenario. Imagine the dollar rebounds strongly. Imagine long-term yields surge. Imagine inflation accelerates. Imagine the Fed signals another rate increase. Imagine gold fails to hold its breakout. Then the current rally could experience a major correction. Silver could fall even faster. That is why the market needs confirmation. Price is important, but price action around key levels is even more important. A breakout that holds is stronger than a breakout that immediately reverses. That is the difference between momentum and exhaustion. Right now, the momentum is clearly strong. Gold has posted its third consecutive weekly gain. Silver has also posted a major weekly increase. Gold futures gained about 5.5% for the week. Silver futures gained almost 7%. Silver was also up more than 20% over the previous 3 weeks, according to weekly market data. Those numbers are impressive. They are also a warning. When an asset moves this quickly, you should expect volatility. Do not assume that every day will be green. There will be pullbacks, there will be profit-taking, there will be false breakouts, there will be days when gold falls while silver rises. There will be days when both metals fall together. That is normal. The bigger question is whether the underlying trend remains intact. And right now, the underlying trend is supported by several factors. A weaker dollar, strong gold momentum, treasury market uncertainty, fiscal concerns, central bank demand, geopolitical risk, and changing expectations for future interest rates. That combination is powerful. It is also unstable. That is what makes the current market so interesting. The biggest mistake investors can make is focusing only on the headline price. Gold at 4,500 sounds impressive. Gold above 4,600 sounds even more impressive. Silver near 70 sounds dramatic, but the price is only the surface. The real story is underneath. The real story is the bond market. The real story is the dollar. The real story is debt. The real story is inflation. The real story is monetary policy. And the real story is confidence. If confidence in long-term fiscal stability weakens, then gold can benefit. If confidence in the dollar weakens, then gold can benefit. If real yields fall, then gold can benefit. If central banks continue diversifying reserves, then gold can benefit. And if investors begin rotating from gold into silver, then silver can move even faster. That is the setup we are watching right now. So what should you watch next? Watch whether gold can hold above 4,600. Watch the 4,700 area. Watch whether silver can hold $70. Watch $72. Watch the dollar index. Watch the 10-year Treasury yield. Watch the 30-year Treasury yield. Watch the next inflation data. Watch employment data. Watch Federal Reserve communication. And watch Treasury debt operations. These indicators will tell us whether this rally is building a new foundation or simply experiencing a temporary burst of momentum. One thing is already clear. The precious metals market is no longer behaving like a sleepy corner of commodities. Gold is trading at historically elevated levels. Silver is approaching major psychological territory. And macroeconomic policy is moving these markets with enormous force. The Treasury announcement showed how quickly the relationship between bonds and precious metals can change. It also showed that investors are increasingly sensitive to fiscal policy. That matters. Because the United States has to manage debt. The Treasury has to issue debt. The Federal Reserve has to manage inflation. Investors have to absorb government securities, and the dollar has to maintain international confidence. Those forces are connected. Gold sits in the middle of that conversation, silver sits nearby. And that is why the current rally deserves attention. The next major move may not come from a gold company, it may not come from a mining report, it may not come from a central bank announcement, it could come from the bond market. That is the lesson from this week. When Treasury yields moved sharply, lower gold exploded higher. When the dollar weakened, gold accelerated. When gold broke through resistance, silver followed. And when silver approached $70, investors started looking toward the next potential breakout. This is not a guarantee of higher prices. It is a signal that the market has entered a period of unusually strong momentum. The smart approach is to respect the trend without ignoring the risk. If you already own gold or silver, then understand what is driving your investment. If you are considering entering the market, then understand that prices can move sharply in both directions. And if you are trading, then remember that volatility can increase quickly around major economic announcements. The most important thing is to stay informed, because the market can change before the headlines catch up. Gold has already shown us that. Silver is now showing us too. The US Treasury has become part of the precious metals story. The Federal Reserve remains part of the story. The dollar remains part of the story. Inflation remains part of the story. Debt remains part of the story. And the next chapter could depend on which of those forces becomes dominant. If long-term yields stay under control and the dollar remains weak, then gold could continue testing higher levels. If silver successfully establishes $70 as support, then the next stage of the silver rally could become much more aggressive. But if yields surge and the dollar rebounds, then both metals could face a serious correction. That is the balance. That is the market. And that is why you should never rely on one headline. Watch the entire system. Right now, the system is sending a very interesting signal. Gold has broken higher. Silver is approaching $70. The dollar has weakened. Treasury policy has shifted. Long-term yields have reacted, and investors are paying attention. The question is no longer whether precious metals are moving. They clearly are. The question is how far this move can go before the market needs to breathe. That is what we will be watching. If you want the latest gold and silver analysis, then make sure you subscribe to Silver and Gold Watch. If you found this breakdown useful, then hit the like button because it helps the channel reach more precious metals investors. And tell me in the comments what you think comes next. Can gold break 4,700 and then move toward 5,000? Can silver hold $70 and push toward 72 and beyond? Or do you think this rally is moving too fast and a major correction is coming? Your opinion matters. Stay alert, watch the dollar, watch Treasury yields, watch the Federal Reserve, and most importantly, watch gold and silver. Because the biggest moves in precious metals often begin when the market realizes that something beneath the surface has changed. And this week, something beneath the surface clearly did.